Investors Chronicle.
Welcome to the Companies and Markets Show. It's Thursday, the 16th of March. Joining me today to discuss banks, the budget, and big pharma are Julian Hofmann, all the way from Devon. Welcome, Julian.
Morning, Dan.
Alex Newman.
Hi, Dan.
Mark Robinson.
All the way from Surrey.
Indeed.
You're not here, Mark. So
You are remote.
You are in Surrey.
Yes, sorry.
And Hermione Taylor as well.
Hello, thanks for having me.
And Jennifer Johnson will be joining us later on. But we're going to start in the obvious place. It was on this day in 2008 that Bear Stearns was sold to JP Morgan for a rock-bottom price. Fast forward 15 years and we have the apparent makings of another banking crisis precipitated by the collapse of Silicon Valley Bank last Friday. I have to confess, when we discussed this in Friday's morning meeting before the collapse, I said when asked that it struck me as a bit of a storm in a teacup. On one level, I do semi-stand by that, but there's no denying that fear has spread far and wide since. We'll come to Europe and the UK in a minute, but let's start with SVB itself and US banks. Julian, why don't we start with you? Your sort of potted summary of what happened and why those concerns have spread in the US in particular.
Okay, yes. So SVB, obviously, as everyone probably knows by now, stands for Silicon Valley Bank. It was a sort of small regional lender in California that lent or had customers exclusively in the tech kind of venture capital trust type space. What happened was that its deposit base suddenly crumbled over fears of liquidity crises and things like that. And it appears that their prudential management wasn't particularly good, so they didn't match their borrowing with their deposit base particularly well. But they also had an issue around interest rates in the US, which have risen quite steeply in comparison to other markets. And it appears that they had to sell far more of their liquid capital in order to meet redemptions, because the rising value of interest rates has also affected the value of liquid instruments like government bonds. So in effect, you're having to sell 100%, 110% to meet 100%. So the two don't add up. It is one of those strange sort of sudden liquidity crisis that actually happens quite a lot in the US. I think that's what people don't quite appreciate, that there's been more than 500 bank failures in America since 2011. So this is one of the latest.
Yeah, this is, as you say, it was a sort of small lender at one point, and part of the problem was that the growth of those deposits from the VC community that it served was pretty extreme. It put those deposits into what, ostensibly are relatively safe assets, treasuries, that kind of thing, but didn't factor in A, the rapid rise in interest rates, and B, the fact that its deposit base, made up of businesses, disproportionately large number of businesses compared with most banks, was, as it proved, pretty flighty. I think it was 42 billion was attempted to be taken out on one day last week, which is, pretty unheard of even in the scale of bank runs. A bit of a herd mentality perhaps in that deposit base, a bit of a trial by social media almost, because once those rumours start, and I think there were talks of WhatsApp groups as well for these depositors who all moved en masse.
It's also it is a fact of the modern day that compared to 2008, where internet banking had only just been 2 or 3 years in the making, when people still had to stand outside the branches, and wait patiently for their money if they wanted to panic. Whereas these days you can just click on a banking app and withdraw all of the savings almost immediately. And the combination of the two is what's precipitated this liquidity crisis, particularly at SVB. But as you say, the concerns have spread in other areas, and it's probably what we'll go into greater depth, I imagine. But
So on that, Alex, maybe we bring you in just on the US in general, because although SVB was very idiosyncratic in terms of that depositor base, other banks have also, a large amount of assets in bonds, long-dated bonds that they won't necessarily be able to liquidate straight away. Not that they necessarily will need to, but that's where the concern is perhaps, that's certainly where the concern has come from, and maybe why this issue is lingering on.
Yeah, definitely. I mean, I suppose much of the commentary has centred on how SVB's particular deposit base is sort of very plugged in technology ecosystem were a particular risk because they either organised very quickly to pull their cash out. But I mean, and I think there's a grain of truth to that. But it's not hard to see, as Julian pointed out, how in the age of smartphones and Twitter, that deposit flight risk, it really is a major issue for particularly smaller banks, because the risk of these kind of spiral dynamics are greater when you're a smaller institution. So we saw this even in the UK. We saw this a few years ago with Metro Bank when there's some prudential concerns following some very poor risk management of their capital, their risk assets. It created this kind of vacuum in which rumours about the security of some of their deposits just sort of ballooned. And luckily then we didn't have a bank run, but there were definitely a few days with Metro Bank where there was definitely some concerns that was a possibility, and you saw some large corporates pulling their deposits from the bank. I suppose the other issue that SVB has highlighted is that banks of a certain size, below sort of 250 billion in assets, I think is around that level, have been. SVB, in their particular case, they apparently lobbied to be excluded from the regulation that affects globally systemically important banks, or larger US banks, which meant that they would have had to take a slightly more proactive risk management approach. In the event, they've gone without a risk manager for sounds like most of the past year. Because there's a lot of fear in the air, lots of other regional US banks have kind of been caught up in this, and there's been some very heavy selling as investors basically have taken the decision to kind of liquidate their holdings of these banks, because the possibility that something might be discovered in the way they've managed risk could be discovered, that might be discovered, is too great a risk for them to take on. So yeah, I mean, you see these events sometimes in the financial sector, where really the fear and sentiment really overtakes fundamentals. Some of these banks are potentially sound, but if enough money gets pulled from them, then suddenly there won't be.
Well, it's also interesting about SVB, and this is what probably applies to the rest of that, what we'd call the secondary banking market, is that on paper they crossed all the T's and dotted all the I's. So they had 50% risk-weighted assets, which is pretty much what the largest institutions have. They were only leveraged about 12 times their assets, 12 times their equity, which is not even that's the baseline. That's not even something to be remarked on, and yet they find themselves in this situation. So that's what has led to people being spooked by it. Because if you think that if that's the baseline and they're still going under, then it could happen in the same way to other people.
I think there's a more basic point as well, and it's linked in with the rapidity of the interest rate increases. There was, as Dan alluded to before, the deposit base of SVB had grown enormously in a relatively short space of time because of the rollout of SPACs and IPOs through 2020, 2021. So suddenly they had this vast deposit base that they didn't have before. A lot of companies, the tech companies, use the bank for their day-to-day operations as well. But it must have come to a point where they've got all this capital parked in sort of in their deposits within the bank itself that aren't earning any money. Meanwhile, inflation's trundling up 8-10%. Interest rates, the Fed reacts, interest rates start to go up rapidly, and then they're going to be looking around saying, what is the point of having this capital parked in the bank itself when we could be obtaining greater returns elsewhere? So that in part that played a part also. And of course you had the situation where then SVB have got all these US bonds in their treasury there. The value of these things are falling. They've got this cash call, basically. They have to sell this, and it becomes sort of an unvirtuous circle.
There is also although as you say, SVB, Julian, SVB didn't do anything wrong by the letter of the, well, certainly not by the letter of the law, but also in terms of, ratio analysis, that kind of thing. But the US does have if not a carve out, then it elected not to apply Basel III rules to banks under a certain size, of which SVB was one of them. And to some extent, those rules would have helped. I think they wouldn't have helped once deposits start flying, as Alex said, because it's difficult to stop anything happening then. But they would have helped in terms of the way it valued its assets, perhaps. But on the subject of regulation, we should turn to Europe, because in the past couple of days, the attention has really focused there on Credit Suisse in particular. Overnight, the Swiss National Bank has come out with some statements of support and some liquidity support, which has, at the time of speaking, seemed to stabilize things. But I suppose, Alex, this is another sign of the contagion and the fear, because again, Credit Suisse, in terms of its balance sheet, all right, is going through this big restructuring. It probably certainly didn't help this week when it said, it had some material errors in the accounts. But in terms of the balance sheet itself, it seems okay for now. But the concern is that, if you get depositor flight, if you get too much worry, that could all go into reverse.
Yeah, I mean, liquidity ratios at Credit Suisse are sound, they've said. So you would, in theory, think then they're able to meet redemptions as they come, and money has been withdrawn from the bank over the last few months. At the same time, they have taken what looks like a much more prudent risk management policy in their hedging of their exposure to interest rates. But to the fear point, it's not wholly surprising that Credit Suisse became the next focus point of the kind of the banking sell-off this week, because it has been the most error-strewn, scandal heavy bank in Europe. So when people are worried about what's hidden beneath the balance sheet or liquidity management of big banks, Credit Suisse is front and center of the concerns. And then, very unfortunately, yesterday we had some pretty poorly worded comments from their largest investor, or it may have been taken out of context, or so it said it absolutely would not give more cash to the bank, which sparked this 30% sell-off on Wednesday. I think there's a reason why the largest investor is not going to give any more, because it would push them above a certain position. But the market read that as a sign that they are sort of abandoning an investment they only made last year. Yeah, exactly. So fear is in the air, and then it spreads really to the weakest links in the chain. I mean, we can sort of talk about, this is a funny week in which we picked the idea of the European banking system.
Yeah, thank you. That was my tip idea. Thank you.
Well, I think come on, we can share. We can share the.
I was thinking about going on holiday.
Yeah. This is the Eurozone, I should say. So it doesn't actually include Swiss banks, but the ETF mentioned in the ideas section this week. I mean, that is the question, really. I suppose people would want to know the answer to, which is impossible to answer. I'm going to put it out there anyway. Given how this contagion has spread and how this fear has spread, is there potentially for a bold investor, an opportunity, certainly maybe in Europe, as we say, or maybe in the UK as well, where banks have sold off, on this fear, not necessarily on, structural concerns.
If I come in on that, I mean, I think that there definitely is, because it all comes down to where the next thing will be, where the people will be looking at the lending book to see where the major loans have gone. And what surprised me in the context of the US banks is that people like JP Morgan and Goldman Sachs haven't been hit as hard. Partly it's because they have the capital rules that we were talking about earlier, but they're also very big lenders to tech companies. So they're combined, they're the biggest lender to SoftBank, for example, which is no one's idea of a brilliant setup. So I think that the value in what we're talking about is going to come down to which institutions in the UK and Europe don't have that kind of exposure, but are being marked down nonetheless. So, for example, the UK banks that we tend to favour, which is people like NatWest or even Lloyd's, they don't have this venture capital angle at all. In their case, it's all about UK property, which that's a whole different story itself. That's a whole different set of risks, but it's not the risk that everyone is talking about. So I think there is definitely an investment angle there to say, well, okay, there's this systemic problem related to one type of industry, that's been funded by institutions that don't have these sets of rules.
It's kind of a real world stress test for the banks as well, which will be quite interesting. But lessons will be derived from that down the track, I imagine.
I was going to say, there is one thing that investors should. We have talked about this a few times on the podcast when we've talked about banking the last year. Is how the kind of the deposit story plays out for even the largest banks. They've been able to benefit from a degree of inertia of lots of their depositors, that they aren't seeking to lock in 4% over the next few years. They are happy to just park their money in effectively a 0% checking account. And managing that risk is a tricky thing, particularly if rates do move higher, or if they are sustained and customers realise that actually they can make their cash go a bit further elsewhere. So that is definitely something that investors thinking of the opportunity here for these slightly more sound UK or European banks need to consider over the next kind of a couple of years.
And related to that is the net interest income question. Of course, in the UK in the past few weeks, we have seen banks disappointing in terms of their predictions for this year and on net interest income, partly in the expectation that the rate cycle may be at an end, partly because there might be more pressure on them to pass on some good rates to depositors. I suppose that story may now be playing out in the US, perhaps even Europe. We've got the ECB meeting after we record, in terms of what the other big impact of the banking situation in the past week is, that the pricing of rate hikes for this year is completely removed, and now we're pricing in rate cuts. We'll see whether
let's see if inflation disappears.
Well, exactly. We'll see if that's sustained. But that's another, that is a material change for the banks in terms of their prospects, if net interest income is not going to be as high as people think. But we should move on because there has been another big event this week, of course, in the UK, which is the budget. And as usual, there was an array of policies announced by Jeremy Hunt yesterday. A lot of them focused on the labour market and trying to get people to either go back to work or perhaps work for a bit longer, which we'll come on to in a minute. But I want to start just on the capital expensing relief, which is a bit of is an attempt to offset the corporation tax rise, which is still coming in. And I wonder, maybe Mark, if you had some thoughts on capital expensing, effectively the ability of companies to offset their capital expenditure costs in full against profits for the next 3 years.
For the next 3 years, that's part of the problem, isn't it? Because people have been calling for this as a fundamental change, because the UK economy has come under criticism in the last few years because of low productivity rates. Part of this is to do with relatively low rates of internal investment, and from left-wing sources as well. The market is often, the public market is often criticised because there's too great an onus on returning funds to shareholders, and that probably bears looking at on a wider basis as well, because I think a business investment in the UK, it accounted for about 10% of GDP, which is lower than well below the average for the OECD, which I think is around about 12.5%, something like that. So there is a problem there. But this just seems to me, as you alluded to before, to be pretty much window dressing when you take it in tandem with the increase in business rates too. So I'm not quite sure if it's going to have that much of an effect. Presumably there might be some industries in the UK that will bring forward planned investment in certain areas, but unless it becomes a permanent feature, I can't really imagine it's going to have that much benefit. Because I mean, a lot of depending on which industry you're looking at, the capital investment tends to be forward loaded and long dated as well. So are you going to really make these decisions based on a 3-year window? I don't know.
Yeah. I should also say this is to replace the super deduction relief, which is also going. But bring in Hermione, who's been waiting patiently on that point about the companies bringing forward rather than increasing capital investment, perhaps. And the OBR did have something to say about this.
I've been enjoying all 168 pages of the OBR's latest report, and they quite crucially say that they expect that this new measure is going to bring investment forward, but it isn't going to lead to any permanent changes. I think that this is actually really interesting because Hunt was very clear to say yesterday in the budget that he wants to make the measure permanent when fiscal conditions allow. And he's bound by these fiscal rules that he's brought in that say that national debt and borrowing must be falling over this 5-year rolling period. But by being bound by these fiscal rules, it looks like he's actually going to limit the effectiveness of this new policy by making sure that investment comes forward, but not actually introducing anything more permanent. So I think we've got to a really interesting point here where it looks like maybe the tail of these fiscal rules is actually wagging the dog of policy and maybe stopping some kind of quite sensible policy being implemented on a more permanent basis.
Yeah, I think that's definitely the case. We will obviously be looking at expensing and its impacts in more detail in the weeks and months ahead, but we should skip on to the other big aspect of the budget, certainly from a personal finance point of view, which is the changes to pensions, taxation, and in particular the removal of the lifetime allowance. That was the rabbit out of the hat, if you will. It had been anticipated to rise from a little over 1 million to 1.8 million, but Hunt got rid of it entirely. This is now the LTA does have a big impact on how people assess the amount of pension they will have and the tax they're going to have to pay. That is now removed. There have been some changes to the annual allowance as well, and the money purchase annual allowance, getting a bit more technical. Both have been increased, so there's flexibility there to add more on an annual level. But in short, the amount you can contribute over your lifetime is currently now unlimited. The reason for this, Hermione, also the government say, is to try and encourage people back to work. I mean, will that work? Will this boost the labour force? This has been a big issue for the NHS in particular.
Yes, so we do have an inactivity problem in the UK. We've got very high levels of inactive workers. So that's workers who aren't working and they're not looking for work either. But whether this will work, I think it's looking very uncertain. So we've got quite mixed data on how much early retirement is driving this increase in inactivity. Some ONS data says that early retirement's had a big impact, so this pension reform could help, but other data suggesting it might be because of long-term sickness or disability. In any case, we've got some research through suggesting that this is really only going to make a big difference to some very high earners. So in terms of overall participation rates, it might not have a huge impact. But the exception, as you said, is the NHS. And we actually had Hunt talking about senior NHS workers when he introduced this policy in the budget yesterday. So we might see that it has quite a big impact with NHS participation rates and people working for longer, but maybe not for the labour market overall. But then I have seen this policy kind of compared to using a sledgehammer to crack a nut. So if you're trying to increase NHS participation, changing this tax-free pension allowance wholesale is quite a drastic way of doing that.
From my point of view as well, they've actually, in scrapping it entirely, they've called a lot of attention to this policy, and Labour have already come out this morning and said they would scrap it, which, you know, is potentially significant given opinion polls definitively suggest at the moment they will be in power probably some point next year. So again, from a pension planning point of view, you know, this is supposed to provide people with the ability to recognise that they will be able to save an unlimited amount. But if you're thinking of that, you think, well, this is just going to get reversed in a year and I will have to pay tax again on my pension above a certain level, then that's not really going to change that too much. I think there's also some issues over IHT in terms of, you know, if you're in a DC pension, again, this is a very small number of people, but you will effectively then be able to save £60,000 a year up to an unlimited amount and then pass that on without paying IHT to your descendants. They will then be taxed at their marginal rate. But I think, the government has perhaps made this a bit of a political football, so we can probably expect more changes to come on this. We shall see. Anyway, time is rapidly marching on, so we're going to discuss our cover story this week, which is on pharmaceuticals and the pricing of their drugs. Jennifer Johnson is here with us. Can we start by sort of talking about the backdrop to this piece, what you were looking at in writing it, what the kind of the issues are in terms of drug pricing, and in particular the pricing of more innovative medicines and medicines targeting small groups of people, which necessarily then perhaps are costing more. And the question really is, are people going to be able to pay for these drugs in future, however innovative, however groundbreaking they may be?
Yeah, so we're reaching kind of a very interesting point scientifically with things like cell and gene therapies, which are these medicines that can treat what are known as orphan diseases. So orphan drugs are treatments for rare diseases, and they're increasingly becoming kind of key to pharmaceutical companies' revenues. Evaluate Pharma, which is a commercial data provider, says orphan drug sales are going to grow almost 12% between 2023 and 2028. This is significantly faster than the 7% which is expected for non-orphan drugs. You might ask, if these drugs are for rare diseases, how are they going to make significant sums of money? These drugs do tend to command much higher prices. That's really the key, in part because they're innovative. And some of the more novel therapies, cell and gene therapies, are usually very effective. So in some cases, it can and has been argued that curing someone with a chronic genetic illness, say sickle cell disease, with a drug that may cost $2 million is more effective in the long run than treating that person over the course of many years. So we're really reaching this inflection point where we now have the technologies and the ability to effectively cure certain diseases that we never had effective treatments for until the kind of past couple of decades. But it's the question of how are pharmaceutical companies going to recoup their R&D costs? How are individuals and healthcare systems going to bear the costs of these drugs? So it's a very, very much a live issue and kind of a tug of war situation.
Yeah, because the backdrop to these breakthroughs is more pressure on pricing in a number of different locales, if you will. The US, for example, the Inflation Reduction Act, which we seem to mention every week at the moment, but that also is going to put some pressure on blockbuster drug prices in future, which could then have a bit of a ripple effect.
Yeah, absolutely. And the thing that we've kind of seen in the news most recently with this is insulin obviously has become a poster child for the excesses of pharma pricing because it's a relatively old drug and manufacturers have found a few regulatory loopholes to uphold their patents and thereby sort of their high prices. Notably, recently, both Eli Lilly and Novo Nordisk have agreed to cut insulin prices in the US, which is fairly significant. Whether this is going to happen anytime soon for really, really high-priced orphan drugs sort of remains to be seen. But there's clearly kind of a cultural moment where patients and healthcare systems are asking pharmaceutical companies, what kind of profit margins do you really need on these kind of things? So it's a conversation that's increasingly going to happen, I think, as orphan drugs become a larger and larger constituent of pharmaceutical revenues.
It does kind of remind me to some extent of, we had a similar thing a decade ago when orphan drugs were just taking off again, post-financial crisis where governments were quite stretched. And I think, for example, AstraZeneca, as with most pharma companies back then, saw a bit of a sales dip on the, Western governments were running out of cash to a certain extent, asking companies to cut prices, buying more generic drugs. So potentially the same kind of thing could happen again. That said, AstraZeneca in particular does have a very strong pipeline at the moment. We have seen in the UK as well, as we touched on this in a previous podcast, some of these issues coming out in terms of the NHS rebate scheme, which excludes innovative drugs, but the very fact that those costs are excluded from this kind of price ceiling, if you will, is effectively pushing up the overall cost of the scheme and causing pharma companies quite a lot of angst.
Yeah, and so the argument from the NHS is that the increase in the health services clawback rate, which is designed to limit the growth of the NHS budget for branded medicines, reflects the faster adoption of new, higher priced medicines by the health service. So while we may not be talking about, $2 million gene therapies, there are higher cost innovative medicines that are now covered under this. So this year, drug makers will be paying 26.5% of their sales back to the UK government, and which a couple of drug companies have sort of said we are pulling out of this scheme. They will now be subject to a more stringent statutory scheme. So it's it's clearly kind of they're protesting this clawback mechanism and it's arguing that it's going to hurt them and hurt their revenues. But this kind of again shows that drug companies, patients and health authorities are going to have to reach some kind of agreement around innovative medicines. There are no easy answers. Pharma companies do need to recoup these R&D costs and ultimately make a profit. But the question then is, what good is creating life-changing innovative drugs if no one can afford to access them?
Some of these issues are slow burning, things like the Inflation Reduction Act, that won't apply if it does limit the prices until 2026 at the earliest. So I suppose the question is, in the short to medium term for pharmaceuticals, are they still expecting their profit margins to remain relatively stable? It seems that as long as the companies still have a good and varied pipeline, if you're a big pharma, this is with a large amount of products available, you should be able to ride this out to an extent. But it's certainly something that is happening at the margin now and may get bigger in future years.
Yeah, and I think it will become bigger. A lot of the really innovative therapies are produced by smaller biotechs, but once some of these things come to market, I'm thinking particularly the sort of major next step in gene therapy is going to be a treatment called exa-cel, which is based on the CRISPR gene editing method, and that's sort of going to be the first. It looks like it's going to be the first treatment to get commercial approval, and again, is likely to be very expensive, multi-million treatment for sickle cell disease. But I think once we start to see more of these treatments coming to market, and potentially big pharma companies seeing the appeal of perhaps buying out some of these biotechs, or at least buying some of their assets, this will come to the fore more broadly. And it sort of depends on an individual company's exposure to orphan drugs. You did mention AstraZeneca, which does have a number of orphan drugs in its portfolio, which are cancer treatments, but it's able to get these orphan drugs approved in multiple indications. So the number of patients actually being treated with a given orphan drug is quite high. So AstraZeneca's got a pretty kind of robust way of operating, but it's once you start to see these gene therapies, these highly innovative and at the moment somewhat speculative gene therapies reaching the market, that this will probably kind of take off.
Jen, thank you very much. Unfortunately, that does bring us to the end of the show. We have run out of time, but thank you to our other contributors this week, Hermione, Mark, Alex, and Julian, and thank you to you for listening. We'll see you next time on another Companies and Markets show.